Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's webinar organized by AASP of ICI on the theme Key Considerations in Audit of Digital Media Sector. As we have taken all these sectors this year and taken in view to discuss with all the members about the various considerations in the audit. So today we are having two learned speakers, CA Lakshay Joshi ji and CA Harshvardhan Dosha ji. So on behalf of AASP of ICI, I extend my warm welcome to both the learned speaker. Lakshay ji, welcome to you. Harshvardhan ji, namaste. We are also having two learned speakers, Rashmi ji and Rishu ji. I also welcome both the moderators for today's webinar. So Honorable Chairman and Vice Chairman both are in one and the another meeting. So I'm taking this liberty to start this webinar and requesting Rashmi Madam to please take it forward. Over to you, Rashmi Madam, please.
Thank you so much, sir, for the handover. Good afternoon, everyone, and a very warm welcome to the entire fraternity in today's 134th CPE program organized by AASP of ICI for this council year. First of all, I would like to extend heartiest thanks to CA Sanjeev Kumar Singhal, sir, Chairman AASP of ICI in his absentia, CA Vishal Doshi, sir, Vice Chairman AASP of ICI in his absentia, and Anil sir for organizing this series of informative webinars where experienced professionals come together to guide and advise other professionals so that we all can ensure and deliver high quality audits. And a very big thanks to the entire panel for providing me an opportunity to be a moderator for today's session. So today we are having two eminent speakers with us who will be sharing the professional knowledge and insights on the topics key considerations in audit of digital media sector. Seeing the vast growth in this area, it becomes one of the most important topics nowadays. Audit of digital media sector is a great way to leverage the power and scope of analytics to perform better audits. Now I am taking privilege to introduce CA Lakshay Joshi, our first guest speaker of the day, who comes with approx 9 years of experience in a statutory audit practice and technical accounting advisory. Lakshay specializes in insurance, financial accuracy, and compliance. Currently, he works with Pyrac Consulting LLP, managing assurance and advisory clients based in India and United States. Throughout his professional journey, Lakshay sir has had the opportunity to work on IPO readiness clients from various sectors, including hospitality, digital media, leasing, and the healthcare. He has extensive experience in implementing Indian accounting standards and IFRS across industries, along with FS finalization. Now, I would like to invite my co-moderator, CA Rishu Sharma, to introduce our second esteemed speaker, CA Harshvardhan Dosha, sir, and take the proceedings further. Over to you, Rishu.
Thank you so much, Rashmi. I would like to extend my sincere gratitude to CA Sanjeev Singhal sir, our esteemed chairman of AASB ICI in his absentia, CA Vishal Doshi, our esteemed vice chairman of AASB ICI in his absentia, and Anil sir for their support and for facilitating these important discussions. I am truly grateful for this opportunity and to be a part of today's event. It's my pleasure to introduce our second guest speaker, CA Harshvardhan Dosa sir. He is a commerce graduate from the University of Mumbai with a specialization in accounting and finance. With 8 years of experience in the field of auditing, he has developed a strong expertise in auditing service industries and foreign multinationals. His portfolio includes handling large private limited companies and conducting statutory audits for limited companies. Additionally, he has substantial experience in valuation and due diligence assignment. He has actively contributed to the field through seminars and training sessions on company audits, auditing standards, and certification assignments both within his firm and at the Institute of Chartered Accountants of India. His role has also encompassed developing working papers and audit documentation as part of the internal team. Moreover, he has shared his knowledge by delivering lectures to CA final students on auditing and assurance. Now I would request CL Lakshay Joshi sir to take the proceedings further and enlighten our esteemed members. Over to you, sir.
Thank you so much, Rishruji. First of all, I would like to thank Sanjeev Singhal sir, Chairman AASB of ICI, and Vishal Doshi sir, Vice Chairman AASB of ICI in their absentia, and especially Anil sir for conducting all these sessions, and both the moderators, Rashmiji and Rishuji, and my co-facilitator, CA Harshvardhan Dosaji, for joining me in this topic on key consideration in the audit of digital media sector. So I'll share my screen. I would request both the moderators, any one of you, please let me know once my screen is visible.
Yes, sir.
Yeah. Are you able to see my screen?
Yes.
Yeah. So, in the growing environment of the technology, like we are seeing over the period of last, I would say last 1 decade, the most important factor or the most important industry which has impacted due to the technology advancement is our media and entertainment industry, because the evolving consumer preferences, increased internet access, I would say, because 82% of the time which Indian population spends on their mobile phones goes to the media and entertainment platforms like OTT platforms, YouTube, and all those media and entertainment channels. So it has increased a lot over the period of last decade. According to a report also by one of the top consulting firm, the country's entertainment, India's entertainment and media industry is expected to grow at the rate of 9.7% annually. And it's not a small amount, because uh, the other industries which are also growing at the lower space, this is the industry which is growing because it is becoming the essence of all the industries uh, throughout uh, throughout the economy. The goal is to reach for this particular industry is 73.6 billion by 2027, which is like 3 years down the line. I think in India also there are so many hotspots, or I would say aspects of the media industry or the digital media industry. These are OTT platforms, which everyone is aware about. Even a very small uh, kid who barely starts speaking, he knows like how to pronounce, how to use the YouTube Kids platform or the Netflix Kids platform, all these backgrounds. So it is becoming the part of our lives today. Then internet advertisements, gaming and esports, generative AI, which has picked up in last 2 3 years now, metaverse, and in all these circumstances, India is basically one of the largest growing platform due to its population size, due to its internet connectivity. It has reached to each and every household today. So this is becoming one of the largest growing industry in India right now. Uh, Audit considerations. So SA will assess, we'll talk about the audit consideration from SA 315 point of view, where how do we identify and assess the risk of material misstatement through understanding the entity and its environment. So there are few basic considerations when we talk about the audit of a business in the digital media industry. So I think before accepting any audit or before getting into any audit of the digital media industry, there are few aspects which we need to understand or which we need to keep in mind while start or while planning for the audit. First one is the relevant industry factors. So how the industry is working, like I said, it's growing rapidly, uh, and the other industry factors as well. For example, what are the compliances are there, how the regulators are working over it, and all those things are the relevant industry factors. Business operations. I think one of the key aspects on the business operation side is how the company is operating. For example, uh, if it is an OTT platform, or it's just a it's providing click ad services, or it's a barter services, how the company is basically, or a motion picture. So there are so many business operations are there. Then revenue recognition. Um, I would cover this in the later slides as well, but the revenue recognition is one of the key focus area for these companies, because a lot of time it happens that the revenue is not certain at a certain point of time, because if I talk about the digital movies, if companies, if a producer is producing a digital movie, so they're not sure about the release date of these movies or when it will get released. So the revenue becomes a very important aspect of the key consideration when we are planning for the audit. Intellectual property and the licensing and royalties go hand in hand, because the kind of technology that the digital media companies are using, do they have proper licenses to it? How are they going to recognize it in their balance sheet or in their financial statements? And how the auditor is going to ensure that all these uh, intricacies are being taken care of by the company, and how do we audit all these aspects of the financial statements? Okay, so the risk associated with the industry. So when we talk about the digital media industry, there are so many risks which is being associated, because if we genuinely talk about it, there was a decade back, there used to be only one kind of media. Uh, Maybe if we talk about the digital media, there used to be only TV or side by side the motion pictures which used to release in theaters. But over the period of time, there are so many new channels that has come up. Channels by I mean it's like online platforms, AR or VR, music applications, and any other applications that we generally use. Uh, Metaverse also. So these are the kind of applications that we are using these days, and it has become a part of the digital media industry. Now, what are the risks associated? First one is the cyber security and data privacy. So everyone is using their mobile phones or the systems or the technology to stream these services, to to enjoy these services. And with the increasing reliance on these digital platforms, the risk of cyber attacks is increasing day by day, because it has become, we come across on the daily basis, we come across so many threats on the cyber security side, that the particular data is breached or there is some bug in this particular technology or something like that. So the cybersecurity and the technology risk is the most important aspect of this particular industry. Then comes the IP risk. Because the media industry heavily relies on IP, auditors need to ensure that proper IP rights are in place and that there are no infringements. So for all the IP rights, auditor has to ensure that there is no risk associated with it. They are complying with all the IP rights that they have, or the obligations if there are any. Regulatory compliances. So different regions have different regulations. So for example, if a company is operating in India and the similar company is operating in another part of the world, so the regulations are different. But if we are auditing uh, that particular company as a in a holistic manner for all the regions, we need to make sure that the auditor or our audit team is basically uh, have knowledge about all these regulatory compliances. So uh, we need to keep up with these regulations and ensuring compliance are there. Again, the technology risk, like I talked about earlier as well, auditor need to make sure that they are aligned with the technology and they have complete assessment of the technologies that are involved. Revenue recognition. So accurately recognizing revenue can be complex, especially with the subscription models, because like in the subscription models, what happens is generally they provide the free of charge for the first 2 months or the 3 months, then they charge their customers. Sometimes there are in-app purchases. You are using one app and then you are taking on the by the click of one link, you are going to the in-app purchases, you are purchasing that app or the ad revenues as well. So auditor has to ensure that the revenue is recognized in accordance with the accounting standards. We'll cover the five-step model on the digital media in the upcoming slides, but this is one of the most important aspect when it comes to the digital media industry. Market and competitive risk. So this is basically being the very highly competitive as well, because with the introduction of AI, so we know that everything is possible. Every kind of content is being created these days now with the use of AI. So, like uh, on a real-time basis, I can give you an example of how one company who is basically working very good, and just because of AI, they might have they are into the business from a very long period, but just because of the introduction of AI, now their users are being shifted to the online platforms that are available to create videos or audios or any artificial intelligence kind of websites that are available. So the market and competitive risk is very high in this particular industry. There are sometimes when they can create a going concern issues as well, just because of the new technologies that is being published these days. Next, the content authenticity and quality. Um, Nobody wants to get into the legal matters, so the content authenticity and the quality has to be there. We Not for the auditors, but for as a company as well. While we are understanding the company, while planning our audit, we need to understand that the authenticity is there, the kind of quality content that they are producing or they are actually giving for their user. So make sure that there are no kind of regulations or the legal acts which can hamper the business operations of the company. So I'll take a few minutes to discuss the accounting considerations on the revenue recognition side first. So based on the five-step model, so once we start on the audit side on the revenue recognition, so first we need to identify the contract. Like there can be multiple types of contract with one party. So the companies need to identify the contracts with customers and make sure that they are legally enforceable as well. Uh, so for example, if an auditor is if planning for the revenue recognition side, so they need to evaluate the terms and conditions as well, what kind of revenue contracts they have entered into, and what are their rights and obligations committed to fulfilling their obligations. Then comes the identification of the performance obligations. So there can be multiple performance obligations when it comes to the digital media companies. For example, there can be a licensing content that has to be produced by a digital media company. They might be providing the advertising services. They might be providing the offer subscription services, or they might be providing the bundle of all these services as part of their contract for the revenues. So once we identify what are the performance obligations are there, now they need to identify the most important part of the transaction price. So generally it is estimated at the contract inception only because it is written in the agreement, but there are so much of variabilities also involved. For example, how many views will be there. So the content producer get the amount, the consideration on the basis of the views that has been achieved. Or if the transaction price is in the variable form, we know that the company has to update it at each reporting period. So for instance, like example has been stated that a music streaming service might estimate future royalties based on user streams. So based on the prior period, their experiences as well, they might be able to estimate like how many views will be there, or what uh, how much royalty they can actually generate in the future periods. Allocating the transaction price. So generally, the standalone selling prices are available on these for these digital media companies because they know, like for example, if they're producing a video of 30 minutes or a content of 30 minutes, so what will be the charges for these particular services? If they are providing the ad services for their models, so how they are going to charge them, what kind of time slots that they are providing, all these comes under the ambit of like while allocating the transaction price. So standalone selling prices are generally available with them. A contract for both content delivery and advertising would allocate the price between these services. Now comes the most important part, like how the company is recognizing its revenue. So the operator, in this case, a digital media operator, we can take any example, but for the sake of it, I won't quote any particular OTT platform or a digital media subscriber, but let's take an example. Let's consider itself as an operator. So the operator recognizes revenue when or as it satisfies its obligations, which is clearly there in India's 115. The entity should apply significant judgment whether the performance obligation is satisfied at a point in time or over a period of time. This is the most important part because contract might suggest that uh, the performance obligation will be satisfied over time or point in time. There might be one time performance obligations, or there might be mix of both as well. So we can take three or four examples to better understand it. So revenue from music licensing is where customer obtains a right to use, is recognized at the time the license is made available to the customer. So, for example, let's suppose that a digital media company who is producing music as well, it goes, it uh, it has its own music streaming platform, and when the customer, so we generally pay on the music applications to use their music and those things, and when the customer obtains a right, so we obtain a right to use it, and not we purchase the song from it, we obtain the right to use it. So it is basically recognized when the license is made available to us. Revenue from sale of television serial episode is recognized upfront at the time of the in time the episode is delivered to the customer. So in this case, like, it's self-explanatory also, but if a producer is producing a television serial, so and it keeps it for a certain period of time, it will not recognize the revenue until the episode is delivered to the customer. So, for example, if you are producing any serial for any particular production house, and you are not the production house, but you are the facilitator for producing those episodes, or uh, those serials. So you will recognize this when the episode is delivered to the customer at that point in time. Theatrical distribution is recognized on exhibition of films. So in this case, we know that there are a lot of movies, there are a lot of films that has been produced, but they are not released yet. So till the time those movies are not released, the revenue cannot be recognized. So the theatrical distribution, when it gets started, the producer starts recognizing its revenue. Free commercial time are recognized when the related advertisement appear before the public, more than when it is telecasted. So, nature and classification in the financial statements. So, as per the framework that has been provided in the by the accounting standard boards for the preparation of financial statements, digital film is generally recognized as an asset because it is a resource which is controlled by the producer legally. It's its own production. It is controlled by it, and uh, it will generate future economic benefits from it. So it is generally recognized as an asset. And there is a clarification also on the classification as an inventory or intangible asset. So generally it is recognized as an intangible asset because it fulfills the criteria of recognition as an intangible asset. But there are two conditions. If those are fulfilled, then it can be recognized as an inventory also. So first one is a media company is producing content that could be sold to anyone. So if there is a content which is prepared, which is produced, and which can be used by anyone in the general public, so then it is recognized as an inventory because it's for a general purpose, and it will be basically a commodity which they will be trading in, and they will recognize that as an inventory. And the second one is for which the producer expects to retain no intellectual property rights. In this case as well, there is no classification criteria met for the intangible asset, so the company will recognize it as an inventory only. There are so many companies which provides different criterias or different practices when it comes to recognition of their productions, their content, as how to recognize as an inventory or why to recognize as an intangibles. So the diversity is there, but while we are auditing these particular cases, these particular industry companies, we need to make sure that we understand the business properly. What is the substance of these businesses? How they are actually operating in these businesses. So there might be cases when there is a company which is producing only for the third parties. They are not producing it for their own intellectual property rights. They are only working for the uh, for the other person. So in all these cases, if we conclude it, we'll generally conclude it as an inventory for their production content. But if a company is producing everything on its own and they are releasing it also, so they will recognize it as an intangible because they will generally reap the future benefits of these production contents as well. So this is the India's perspective under Schedule 3, Division 1 and Division 2. So the following categories. So our index specifically talks about the motion picture films only. There is no mention of the digital media sector, but we can take the analogy from the motion picture films because it somehow goes in hand. And so the following categories are defined by the standard to be disclosed separately under intangible assets. So if you have copyrights or patents or any other intellectual property rights or services, those will be classified separately. And if there are any licenses or franchisee which you have acquired for any other from any other company where you are using it, so it will be classified separately from all other intangible assets. Let's talk about the auditing consideration when it comes to audit the revenue side. So there are three basic assertions when we think about the audit procedures of the revenue. First one is the occurrence. So, and the procedures that we generally perform is vouching of transactions and ensure whether service is actually provided. So while uh, we are performing our audit procedures around the occurrence, we need to make sure that the service the company has actually provided its services. So again, it comes under India's 115, the five-step model. We need to understand how the contract is being drafted, what are the performance obligations that is there, how the company has allocated the transaction price or determined the transaction price, and whether the company has fulfilled all its obligations. So if the company has fulfilled all its obligations, it ensures that yes, there is an occurrence of the revenue recognition transaction and whether the service is actually provided. I think on the occurrence side as well, when service is actually provided, there is one more intricacy which comes into the picture is if a company is producing content, it's a digital media company, so we can and it's available for a public viewing, so we can definitely understand yes, the revenue has the transaction has occurred and the company is eligible to recognize the revenue. Then comes the accuracy assertions. We can definitely recalculate. This is a general procedure that we performed around the revenue recognition side. Compare it with price list and the agreement. We need to make sure that whatever the subscription, for example, if we are having a subscription based model, so we need to compare it with the price list and the agreement which we have generally entered into with our customers. For example, if it's a 24 months subscription model or a 12-month subscription model, 6-month subscription model, so we can compare it and then recalculate it to make sure that the revenue is accurately recorded. Cost plus model. So it's a very interesting model as well. To make sure that, so sometimes what happens is the company is producing its content for their, their the companies. For example, the company there are this is a multinational company and it has a center in India and it is a center in US or any other part of the world. So if a company is utilizing the resources in India to generate or to produce any particular content in, let's suppose, in any other part of the world, and it generally operates on the cost plus model. So how do we calculate the actual amount of the revenue? So we'll just calculate the revenue amount from the total expenses. For example, they have entered into an agreement where the uh, their Indian force will be utilized to create that particular content, and what is the cost that is involved in their production. And then on that basis, we will make sure that the revenue is accurately recorded. Completeness and cutoff. So I think in this particular case, we need to make sure that we need to focus on the service period. Like I said in the accuracy part as well, we need to make sure that what is the subscription period, or you can say what is the licensing period, and for how much period the content is available for the public viewing, and all those periods, all those things we need to understand. Then comes the unbilled revenue versus unearned revenue. So generally people get confused between these two topics, like what is the unbilled revenue and what is unearned revenue. So unbilled revenue is something where you have actually performed your side of the obligations. The company has performed its side of the obligations, but it has not invoiced to the customer for that particular revenue. So that is called the unbilled revenue. Versus the unearned revenue is something where you have received the payment from the client, from your customer, and you have not performed your uh, obligations towards it. So how the company is calculating all these unbilled revenue versus the unearned revenue. This is the most, in my personal experience as well, this is the most technical aspect of the revenue when we audit the revenue side for a company. Because it happens a lot of time, because these projects where the digital media company operates, so if they are working for a particular customer, so they operate, these projects go for maybe for 2 years or 3 years. So there are so many object clauses in the agreement where they are performing their obligations, but they do not have the right to receive the payment, or they do not have the right to invoice those customers, but they have actually performed their side of the obligations. The next one is also the in the similar way, they have received the payments in advance, but the obligations will continue for the next 2 or 3 years till the time the project is not completed. So in all these cases where we are producing the content for the third party or a individual or a customer, where we are not the particular company who's going to publish it on our public view. So in all these cases are very crucial to understand how we are going to audit the unbilled revenue or the unearned revenue. So if retainership agreement ensure all 12 months revenue is recorded. In this particular case as well, there are retainers, like I said, like the subscription agreement, there are retainership agreements as well. And we need to make sure that all the 12-month revenue has been recorded, because I'll give you an example. Let's suppose a video streaming website, we all know. So they have multiple customers who are basically paying them on each and every month. Some pays them on a 12-month basis or a 24-month basis. So they have like thousands of customers who are actually availing those services. So the auditor needs to make sure that the revenue is recorded completely for all those customers. So we need, on a sample basis, we need to make sure that the retainership agreement for all the 12 months have been recorded. The revenue from those agreements have been recorded properly. So we'll walk through one of the case studies. Yeah. So it's basically a click-based model. The facts of the cases are that the company hosts an online shopping site, and in addition, it also hosts digital advertising for advertising customers. Such advertising customers may or may not be those companies who sell goods on the online shopping site. The advertising companies want to have users come to their site via the company's site. So if I give you an example, so you open one application and you see that there are few advertisement that goes on, and when you uh, click on those advertisements, it takes you to some other website. If no one enters on advertiser's site, nothing is earned by the company. The company does not design the digital advertising, but provides a defined space on its site where the advertisers put the advert for their site. What is the performance obligation? So in these cases, what generally happens is the confusion lies what are the performance obligations from a standpoint of a digital media company. So there might be they might be think that the each click is their performance obligation, or just the advertisement is their performance obligations. So when we conclude on it, the response is generally that the providing advertising services over a specified period of time is the performance obligation for the company. So the click through, so when you click on this particular ad, is merely an outcome, and it determines the consideration, but the actual service, actual performance obligations that they are providing is basically their space for that particular site. So that is going to be the performance obligation for the company. In this case, the company will recognize when it's certain, which will be when a user clicks on the advertiser site. So based on each click, they are certain that the company is providing the advertising services, and on the end, they will recognize it over the period of time that the advertising services are being provided. If the company receives a fixed consideration also, it shall amortize it over the advertising period along with click-through variable considerations. Yeah. So I think that was my part for the webinar, and now I would like to invite Harshvardhan Dosaji to enlighten more on the auditing consideration on the digital media side.
Hi, thank you, Lakshya, for the handover and for giving us a wonderful explanation on some intricate parts of the audit of digital media sector, especially focusing on revenue recognition. I will just share my screen just 1 second. Okay. Okay, my screen is visible, right?
Yes, sir.
Okay. So, first, let me just give a very brief introduction. Again, CA Lakshaji has given a brief introduction. The topics and the different types of media or the different types of industry that we will be looking at would be our television, digital media, print services, film media, online gaming, etc. Now, we have already seen that in the recent times, there have been a lot of movement and a lot of upscale of the digital media sector. Today, all of us, anyone who has a mobile phone is on digital media at any point of time, whether be it just any OTT platform, or in fact, nowadays also what has happened is earlier we used to have physical newspapers, we used to read physical newspapers. Even news media today is on our mobile phones. So that is how digital media has been growing over the last couple of years. So if we look at it, India is spending around 82% of its time on mobile phone apps on media and entertainment. 93% of YouTube viewers watch content in Hindi or any other regional language. So today, it's not just that the urban or the metropolitan cities have digital media access. The digital media access is with everyone all around India. And Indians spend, just if we look at the staggering number, Indians spend 1.9 billion plus hours on online sports, among the most time spent in the world. Among all over the world, Indians spend the most time on watching online sports. And one of the major sports, if I would see, we would be watching is the IPL whenever it comes for those 2 months. Sometimes it feels that, oh, it is getting too much. There's too much of cricket in a period of 2 months, and then suddenly when IPL gets over, all of us are kept on wondering that, oh, now what are we supposed to do after 7:30? So that is where we are connected or used to the online media. Then the share of regional TV and OTT consumption has reached 50% in 2022. So it's not just that the TV and OTT consumption is there only in the mainstream English or Hindi languages. Even regional content has increased its share to 50%. Another upcoming segment in the OTT platform is your animation segment, which is now growing amongst all youngsters. Now, if we look at it, what are the certain government initiatives? They have digitized the cable distribution sector to attract greater institutional funding, increasing the FDI limit from 74 to 100%. So earlier 74% FDI limit was there, which has now been increased to 100%. Similarly, firm facilitation offices have been set up by the Ministry of Information and Broadcasting to act as a single window clearance and facilitation for producers and production companies. Recently, we have seen there have been mergers of film media units in December 21, Ministry of Information and Broadcasting under one corporation will lead to convergence of activities and resource for better coordination. We have also seen certain mergers and acquisition in the recent times in the digital media sector. One of them is, of course, we all know PVR Inox is now comes under one head. It is one company that a merger had happened. Also, we have been seeing, or there was some recent, in fact, very recent news that Paytm was looking to sell off its ticketing business to Zomato. So Zomato was also going to enter, or is maybe going to enter into the online ticketing business, just like BookMyShow. So these are the certain things which have been happening and other initiatives. Now, if we look at the recent budget analysis, how or what impact has it had, or what are the changes that it has had in for the digital media sector? First, there has been a reduction in the corporate tax rate for foreign companies from 40% to 35% to attract more foreign companies working in operating in India. Also, there has been withdrawal of 2% equalization levy on e-commerce supply or services, thereby giving them more revenue and simplifying the process. For the countries looking for digital continuity solution, government will facilitate setting up of the databases in GIFT City, the new IFSC center for the export of services, what has come. And also, if we look at it, the basic custom duty, there has been basic custom duty exemption, which has been provided to motion pictures, music, gaming, software, television equipment, etc. for using in gaming console printed or recorded on media, which has been extended till March 2026. So all these are the government initiatives which have been happening in the digital media sector. Now, when we talk about the digital media sector in India, what media and entertainment sector we are looking at? It could include your television services, it could include digital media, it could include filmed entertainment, online gaming, advertisement, sports media, as well as print sector. Now, when we talk about televisions would include your plays, TV dramas, telestories, classical music, and all other religious programs. Advertisement would include direct-to-mail advertising, radio advertising, paid search advertising, and native advertising, etc. Your digital and social media would cover videos, articles, advertisements, music, podcasts, etc. And of course, sports and live events are the new upcoming thing. Nowadays, we also see theaters broadcasting certain major sport events. So if there's some IPL final, or if there's some World Cup final, which has been broadcasted by the theaters as well. Gaming, augmented reality, VFX effects, and all of that has been upcoming. Along with that, there has been print media, which print media would include your newspapers, magazines, etc. Like I said earlier, every day in the morning, a newspaper used to come at home. Now that has been changed to a subscription of Business Standard or a subscription of Live Mint on the phone. And other than that, there was also film entertainment, which includes your films, documentary, web shows, etc. Okay. So before we commence any audit, I understand Lakshya had also covered a little bit of standard SA 315, which talks about identifying and assessing the risk of material misstatement through understanding the entity and its environment. At any point of time, whenever we commence any audit, or whenever we look at commencing any particular sector, first it becomes important for us to understand what industry the particular company belongs to. After understanding which industry it belongs to, we need to understand what are the regulatory factors which would come into play. Now, we can come to know the regulatory factors, or we can come to know the other factors only once we understand the kind of industry in which the company is operating. So first, at any point of time, we have to look at the macro stage. And after we understand the macro stage, then we come to the nature of the entity, where we go to the specific nature of the entity, where the entity is in its life cycle, what are the threats to the particular company, what are the growth opportunities for the particular company, what type of pressures are there on that particular company. If it is a listed company, is there a pressure on for the business, for example, if it's a listed company like Balaji Telefilms. Balaji Telefilms produces shows also. So what is the risk factor involved in each of the specific types of entities? What are the objectives of the entities, and what are the geographies in which the entity is operating? After that, we need to understand the selection of entities, selection and application of the entity's accounting policies and what accounting estimates that the entity follows. And lastly, we need to also look at the financial performance of the company. Uh, as I understand, Mr. Lakshay CA Lakshay has covered revenue recognition in quite a bit of detail. So we will not be touching upon revenue recognition, but other than revenue recognition, we will be looking at other types of other areas. So various types of risk assessment procedures we will conduct. First is inquiry of management, inquiry of others within the company or outside the entity, observation and inspection of the documents, etc. If the entity has an internal audit function, we need to coordinate with the internal auditor what is their understanding of the entity and what are the analytical procedures which have been and we can use analytical procedures to identify what are the high variance areas. So initially only when we receive the trial balance or when we receive the financial statements from the company, we can perform initial analytical procedures as part of our risk assessment to understand which areas has major variation compared to the previous years. And whichever areas have major variation compared to the previous years, those are the areas where there would automatically be a high risk areas. Just a little bit brief on audit procedures. We undertake risk assessment procedures under SA 315, which is identifying and assessing the risk of material misstatement through understanding the entity and its environment. So as part of SA 315, we undertake risk assessment procedures where we assess what are the high risk areas. And once we have assessed what are the high risk areas, we move on to the further audit procedures. In further audit procedures, we perform test of control as well as substantive procedures. Now, test of controls are those audit procedures that we perform to identify and assess the risk of material misstatement. Those test of control are those procedures that we perform to evaluate the operating effectiveness of internal controls. My mistake. In test of controls, these are those procedures where we evaluate the operating effectiveness of a company's internal controls. And under substantive procedures, SA 330 is very clear. Substantive procedures are to be performed for every material class of transaction, account balance, or disclosure. What is included in substantive procedures are your test of detail as well as analytical procedures, be it vouching, verification, or you can do analytical procedures. But SA 330 is very clear in saying any material class of transaction, disclosure, or account balance is there, you have to perform substantive procedures. Also, sometimes there is often a misconception that if reporting on internal financial controls is not applicable, so I don't have to do test of controls, which is not the case. Test of controls, why do we perform test of controls in any company? Because always as part of substantive procedures, we will never be doing 100% checking. We will always be doing a sample testing and deriving at a conclusion on the entire population only based on the samples that we have tested, isn't it? So at that point of time, we cannot say that we will not perform test of controls. We need to ensure that throughout the year, the controls have been operating effectively, and therefore, whatever observations or whatever issues were there in the samples whatever controls were there in those samples that you have verified would be there in the entire population as well. So this misconception is often there that test of controls is to be performed only when reporting on IFC is there, which is not the case. Irrespective, test of control we need to perform for all areas. Moving to specifically digital media and entertainment sector, there are certain major areas where we can check what substantive procedures we need to perform. So first major area would become your property, plant and equipment and intangible asset. Apart from revenue, the major area for one of the major areas for digital media would be your property, plant and equipment, which is your fixed assets, or your intangible assets, which would be your rights obtained, licenses obtained, etc. So what are the audit procedures, substantive audit procedures that we can perform? First, we can obtain the property, plant and equipment register along with the register for intangible asset. Many times what happens is companies do not, some companies may not be maintaining register for intangible asset, but for digital media sector, for entertainment sector, they have a lot of subscriptions, a lot of license fees, etc. So it becomes important for them to also maintain register for intangible assets. So as auditors, we also need to check and verify their register for intangible asset. Further, also verify the movement in property, plant, and equipment and compare the movement with the previous year. This is very basic. Whatever movement, additions, deductions is there in the current year, compare the same with the previous year as well. After that, for additions, vouch items for classification, accuracy, valuation, and approval. In case of intangible, you can also verify the recognition criteria as per AS 26 intangible asset or Ind AS 38 intangible assets. Further, we also will verify obviously the correct depreciation has been charged either as per the accounting policy or as per Schedule 2. If the management is not using the depreciation rates which are mentioned in Schedule 2, then the same have to be disclosed in the accounting policy of the company. What I have done is in the futures, in the slides ahead, I have taken up some of the accounting policies of the listed companies. So there we will see what are the different types of useful life that the listed companies are considering for digital media sector. Then we should verify the movement in intangible assets, just like we verify the movement in property, plant, and equipment. Also ensure that various patents and copyrights have been appropriately capitalized and no cases of infringement is pending on the entity. Again, this is a any case of infringement would be like that if the company has violated some trademark, the company has copied some other product, etc. So as auditors, we should ensure that there is no case of infringement against the company. So another important area which comes under this digital media will be your litigation. We have to obtain reports from the external counsel to understand what are the cases against the company in this particular sector and whether those cases need to be recognized either as contingent liability or as actual liability. Further, it becomes very important to carry out an impairment assessment on the property, plant, and equipment and capitalize intangible assets of the entity. So it could be possible that the company has capitalized certain intangible assets, such as your software is there or your broadcasting rights are there. So broadcasting rights would be an intangible asset which the company would have capitalized. So every year we need to compare whatever is the WDV of the particular broadcasting rights which you have capitalized and match it with what is the future economic outflow that the company expects to receive. If the company expects to receive future economic outflow which is less than the written down value of the particular intangible asset, the company would need to write down the value further to the whatever is the future economic value it expects. But of course, if the future economic benefit that the company expects to receive is higher than the than the WDV of the asset, then of course we don't need to do anything. Okay. Another major area for these entities would be your employee benefit expenses. As part of employee benefit expenses, we would compare the payroll register with the entries passed in the books of accounts. So whatever salary is appearing in the payroll register, whatever total salary is appearing in the monthly payroll register, you can compile and combine the monthly payroll registers and verify with the entries which are recorded in the books of accounts. Further, statutory dues as part of employee benefits again becomes an important thing. These entities are generally very heavy, employee heavy entities where employee checking verification becomes important. As auditors, we should recompute the PF deduction as a percentage of basic salary, 12% of basic salary. So we need to recompute that the PF deduction has been correctly done. Also ensure compliance with provident fund and professional tax laws. Different states have different types of different profession tax with different monthly regulations. So we need to verify those compliances and as well as compliance with provident fund act. Such entities may have multiple incentives paid throughout the year, obtain policies of various incentive payments. See, not only that they would have multiple incentives paid throughout the year. If we look at the next point, generally incentive may be on a calendar year basis. So if the incentive is on calendar year basis or the bonus that is paid to the employees is on calendar year basis, then we have to ensure or we have to verify that appropriate provision has been created for 3 months. So in India, we follow the financial year April to March. So if the bonus period is Jan to December, then always Jan to December bonus will be paid in the month of January or next January or February. But still, you will need to create a provision for the remaining 3 months, which is January, February, and March of the year, to ensure that appropriate accounting has been happening and you are following the accrual system of accounting. Further, verify the new joinee details on sample basis. We will verify the new joining detail on sample basis, verify the joining letter, verify the salary as per the joining letter, whether it is same as what is captured in the payroll register. It is important to note that whenever employee is joined in the middle of the month, we have to ensure that employee is being paid salary for the first month only for the part of the month which the employee has worked, and the employee should not be paid salary for the full year. So that should be full month. That should be the full. That should be the control that we as auditors should have. Also verify the resignee details on sample basis. If the employees have resigned in the middle of the year or in the middle of the month, then employee should be paid salary only till the date of resignation. And in the next month, the employee should not be getting any salary. That is a check that as auditors we are supposed to do. Further, as part of resignation, we should also verify if the employee was entitled to any gratuity or if the employee was entitled to any leave encashment, and the same component has been paid to the employee. Understand the increment cycle, verify the increment details on sample basis. So at any point of time, if the employee receives increment, there would be an increment letter or some document which would be shared with the employee. We need to verify those documents to ensure whenever there is a change in the salary of the employees. And as part of our audit, we can recompute the TDS, which is deducted for employees under 192B. Okay. For employee benefit expenses, we need to also understand the applicability for actuarial valuation on gratuity and leave compensation. So to understand the applicability of actuarial valuation and leave and compensation, let us understand first, what do we mean by a small and medium-sized company? A small and medium-sized company, as per the accounting standards rules, which are prescribed by the ICAI, an entity which is not listed or in whether in India or outside India or on the process of being listed, an entity which is not a bank, financial institution, or an insurance company, an entity whose turnover is less than 250 crore, and an entity whose borrowings at any point of time in the previous year are less than 50 crores. And it should not be a holding or a subsidiary company of a company which is not an SMC. If all these conditions are satisfied, then the company will become a SMC, which is a small and medium-sized company under the accounting standard rules. When the entity becomes a small and medium-sized company under the accounting standard rules, it affects on the actuarial valuation required. It is not necessary that at every point of time you will require an actuarial valuation. So if you look at it, look at this table out here. Whether provision is required for short-term benefits, yes, provision is required. For post-employment benefits, be it actuarial valuation or leave encashment, whether it is required, yeah, of course, the provision is required. Whether the company is a non-SMC or the company is an SMC, you need to create a provision. Only that what will be the method of provision creation will vary depending on whether the company is an SMC or not. For other long-term incentives or other long-term benefits, whether the entity is a non-SMC or an SMC, you need to create a provision. Second, if we look at the second column out here, whether the provision needs to be as per the actuarial valuation, which is nothing but using the projected unit cost method. So here, if these are short-term benefits to employees, of course, you do not need to use actuarial valuation because the benefits are short-term in nature. The provision is short-term. Post-employment benefits such as gratuity, leave encashment, etc. So if you look at post-employment benefits, if the company is a non-SMC, which means that the company is not a small and medium-sized company is a big company. If the company is a big company, automatically the company has to obtain actuarial valuation irrespective of the number of employees. However, if the company is an SMC, which means the company is a small and medium-sized company, up to 50 employees, then you can create provision on any arithmetic or discontinuance basis. You do not need to use actuarial valuation. However, if it is an SMC with more than 50 employees, then actuarial valuation is required. So there is an exemption which is not a complete exemption, but a partial exemption which has been given to SMC companies. Any SMC company up to 50 employees, they can create a provision based on some arithmetic basis. They need not create provision based on percentage of completion, projected unit cost method. For other long-term liabilities, again, if it is a non-SMC, you need to create SMC up to 50 employees. You can create provision on arithmetic basis. More than 50 employees, actual valuation will be required. And whether detailed disclosures will be required or not, it is very simple. If the company is a non-SMC, you will need to have detailed disclosure in the notes to accounts of the financial statement. But if the company is an SMC, detailed disclosures are not required. Apart from actuarial valuation, one more important provision that needs to be created for these kind of companies are the provision for compensated absences. So compensated absences is nothing but leave encashment. If the company, so if we can basically divide the compensated absences into two parts, accumulated and non-accumulating. Non-accumulating means, let's say at the end of the year, if all the leaves of the employees gets lapsed, the employees cannot carry forward any particular leaves in the next financial year. That would mean that the leaves are non-accumulating. If the leaves are non-accumulating, automatically there is no need to create any provision because there is no leave balance as at the year end. However, if the leaves are accumulating, whether it is in whether the leave encashment is going to be in cash or the leaves are non-vesting, which means that the employee will not receive any cash, but just that the leaves will be carried forward. Irrespective, on leave entitlement as well, you need to create a provision for compensated absences. So it is not necessary that provision for compensated absences needs to be created only when the actual outflow is going to be there in cash. Even if there's not going to be any outflow in cash, but the leave balance is getting carried forward without cash outflow, still you will need to create a provision for leave encashment. Now, whenever the management is using its expert as per SA 500, management will always send this particular data to the actuary to compute the actual valuation liability of leaves as well as gratuity. As part of auditors, we need to verify the arithmetic accuracy and we need to verify the data which has been sent to the actuary. Now, that data could be the total number of employees. So whatever is the payroll register as on 31st March, you compare the employees as on 31st March in the company with whatever data has been sent to the actuary. Other than that, we will compute the salary from the payroll register. We will verify the average age, average period of service, leave data calculation, attrition rate, escalation rate, discount rate. Now, when we see the last three things, attrition rate and escalation rate, these are the assumptions which are used by the entity. And these are the assumptions which are provided by the entity to the actuary to conduct actuarial valuation. Attrition rate is nothing but the employee leaving rate. And escalation rate is nothing but the increment rate that the company expects to give to its employees. As part of our audit, when we do verification for actuarial valuation, we need to verify the attrition rate as well as the escalation rate and whether it is in line with the past average of the company. So let's say, for example, many times we see that the past average attrition of the employees is barely 5 or 6%. Not many employees leave the company. Employees are happy with the company. Employees are there. But if the company, while giving the assumption to the actuary, if the company gives the attrition rate of 15% or 20%, it would automatically reduce the liability because then the actuary would assume that all the employees will not stay for a long period of time. Similarly, for escalation rate, we need to check with the average last 3 or 4 years how much escalation has been given to each, how much increment is given to the employees. On average, we can remove a percentage and verify that that percentage average of last 4-5 years should not be very different from the escalation rate. Now, a general rule of thumb could be that as much as is inflation, that much escalation to employees are going to get. So if the inflation in India is 5 to 6% or 5 to 7%, minimum 5 to 7% escalation should be there that way. Apart from that, one of the major points under employee benefit expenses would be verification of policy of share-based payments. Many of these companies provide employee stock options, share options, etc. So that to their employees. So we need to verify what is the policy of share-based compensation to the employees, how much expense we need to recognize, and that for that particular purpose, we should ensure recognition of expense as per the guidance provided by the institute. There is a guidance note on share-based payments which has been which the institute has provided. We need to verify, we need to check that particular guidance, and based on that guidance, we need to recognize the expenses. Okay, this is done. This is also done. Another major area is rent expense. Again, rent expense is fairly simple. We should obtain a listing of whatever premises that the company has and how much is the obtain the agreement of all those premises. Based on the agreement, we should verify how much is the monthly rent expense for each of the particular premises. And then based on analytical procedures, we can compute the entire year's rent. And that becomes very simple. One additional thing that we should verify, the seating capacity of the premises and compare the seating capacity of the premises with how many employees number of employees the company has. It is possible that the seating capacity of the company or of the premise is only 50 to 60, whereas the actual number of employees that the company has is 120. Then obviously, if that is the case, it raises a question that how can your seating capacity be only 50 or 60 whereas you have 100, 120 employees? Then the explanation could be very simple, that the company has a work from home model. Generally, in all these digital media sectors, they have a lot of work from home, and they have to what do you say? They have to create a ticket whenever they have to come to office to book a particular desk, etc. So we can verify that from the policies of the companies. Vouching of rent expenses, etc. has to be done. It's fairly simple. Let us look at the synopsis of certain accounting policies of some of the companies. So this is one of the accounting policies of PVR Inox. When we look at property, plant and equipment depreciation, what they say that the management believes that these estimated useful lives are realistic and reflect a fair approximation of the period over which the assets are likely to be used. So even if for concession equipment, gaming equipment, projectors, etc., they have given the useful life as per Schedule 2, which has been prescribed by Companies Act, whereas the management estimates a different useful life. So the management in this case, if we look at it, for concession and gaming equipments, the management estimates a useful life which is lower than what is prescribed by the Companies Act. So in that case, we have to ensure whether the management has disclosed it, and we as auditors would also need to ensure how the management has arrived at this particular estimate. Because if we look at gaming equipment, 13.33 years, it's a very specific number, 0.33 years. So we need to understand on what is the basis on which the management has arrived at this useful life. Similarly, vehicles and LCDs, windmills, etc. All these are the cases. Generally, residual value is 5%, which has been prescribed as per Schedule 2. So for residual value, this particular entity, what they mention, the company has estimated the residual value at 5% of the original cost of all assets, except for sound and projections equipments, which are taken at 10% of original cost based on technical assessment done by the management. As part of audit, it becomes very important to obtain this technical assessment, which is done by the management, to increase the residual value of the particular software of the particular asset. So that is something that which we as auditors would need to obtain. Further, if we look at synopsis of intangible assets, film rights. Film rights are nothing but the rights acquired by these particular theaters to project or to give to project the particular movie on their screens. So films rights. Film rights are something that the rights acquired or created, capitalized as film rights and amortized based on management estimates. Generally, what the management would do is management would amortize these film rights over a period of over the period for which the management estimates that the film will run in the theater. So let's say, for example, if a film is released in the last week of March, the management estimates that the film will be run over a number of shows. So what they can do is, depending on the number of shows, they can amortize the rights of the film. Similarly, brands and beneficial rights. Acquisition of Inox Cinema comprise of beneficial lease rights, which are amortized on straight line basis over the remaining lease period, and brands are amortized on straight line basis over a period of 20 years and tested for impairment annually. One very important thing that comes out here is the testing for impairment, which has to be the test of impairment has to be done by the management, and year on year we need to test for impairment whether the actual receivable value is more than the written down value. Similarly, if we look at Balaji Telefilms, unamortized cost of films, many times it could be possible that at the year end, the film is not completed or the particular show is not completed, right? It is not necessary that they will follow our financial year and they'll complete filming of everything before 31st of March. So if the film is not completed and it is ongoing, so there would always be certain cost which has already been gone or certain cost which has already been incurred in producing that particular film. Unamortized cost of films is amortized in the ratio of current revenue to expected total revenue. At the end of each accounting period, balance of unamortized cost is compared with the net expected revenue. If the net expected revenue is less than the unamortized cost, same will be written down to the net expected revenue. It is very similar to the impairment assessment that we do. If ultimately the company estimates that the future revenue from the unamortized cost is going to be lower than the value which is appearing in the books, then the unamortized cost will be written down to the expected revenue itself. For this particular company, again, they considered studios and sets. Any studios or sets that they would have created, they have taken the useful life of 3 years, which is different from the useful life as per Schedule 2. Okay. Similarly, if we look at Viacom 18, which is again a media industry, in Viacom 18, if we look at the cost of shows in inventory, they would have different cost of shows, events, and film. It is expensed off based on the expected pattern of realization of economic benefits. And this would not be like a normal inventory, which is just whenever the inventory is sold, this particular item would get consumed. Here, since they would also have broadcasting rights of these particular shows, they are generally expensed out in the expected pattern of realization of economic benefits. Similarly, if there are inventories from acquired rights of shows and music rights, then they are amortized evenly over the license period, over the period for which they have a license to broadcast these particular shows. Different types, another type of property, plant, and equipment are projects under which assets are not ready for their intended use, which are shown as capital work in progress, which is fairly simple. Again, these are the accounting policies for TV 18. Just like Viacom 18, there is TV 18. So these are the various accounting policies of TV 18. For inventory, first two items remain the same. Programs purchased, and the third item, if you look at programs purchased and the cost of programs produced in-house, these are expensed off based on the number of episodes telecasted during the period. So based on the number of episodes which are telecasted in the period, these will be expensed off. Cost of news, current affairs, one-time events are expensed off in the first telecast itself, because if whatever cost goes in acquiring some news, be it from their particular source, etc., that cost is already expensed out. The revenue, the benefit of that is expensed out when the company has telecasted for the first time. So as soon as the company telecasts it for the first time, they expense off in the first telecast itself. And capital work in progress. So these were certain major TV and digital media sectors for which we have seen the various accounting policies that they follow. When we look at key audit considerations for inventory, we need to verify the recognition criteria, whether the particular criteria falls within the definition of inventory, or whether it falls in the definition of property, plant, and equipment, or whether it is a P&L cost which has to be straight away expensed out. Broadcasting right is an element of cost which the broadcaster incurs for providing sales. So if there is any broadcasting right, then of course it can be amortized over a period of time. We need to verify the recognition criteria for PPE, whether it falls under fixed assets or whether it falls under inventory. Measurement of cost. What is cost? Cost is nothing but cost of purchase plus cost of conversion plus other costs which are incurred. So at what price would this particular TV shows or the content which has not yet been published, what would be the cost that has gone in the verification of the making of the content? We need to check whether it is measured properly. Consumption, you need to verify the ratio of current consumption versus what is the expected consumption. Is the consumption happening as per the what is expected or not? It is important to verify the value of inventory. How do we verify the value of inventory? Valuation of inventory is generally lower of cost or net realizable value. So we need to understand what is the benefit that the company is going to be deriving from this particular cost of show. If the benefit that the company is going to be deriving is higher than the cost, then you can state the inventory at cost. But if the benefit that the company is going to derive will be lower than cost, then you will need to write down the value of inventory. Similarly, cost of incomplete projects. Whenever there are any ongoing projects, either you can put it in WIP, but of course, these are not work in progress, which will be capitalized. These are work in progress, which will form part of your inventories. And you may not call it as work in progress, but they generally call it as cost of incomplete projects. Okay. Moving to property, plant and equipment and intangible assets, recognition of license fees, satellite telecasting rights and amortization becomes important. Further capitalization of electrical installation, machinery, studios, equipment, etc. We need to verify that they have been capitalized properly. They have been depreciated properly using the proper useful life. If the management is using a different useful life than what has been prescribed, then the same has to be disclosed in the accounting policies of the company. What constitutes cost and whether the future economic benefits are going to be higher than the written down value of the asset. Impairment testing again becomes very important for the PPE as well as intangible assets in these companies. Okay. Certain other industry specific issues. If we look at other industry specific issues, there could be some regulatory or government action. Sometimes so we see that certain movies ban, certain products get banned. So for example, there were many gaming apps. Whenever in 2020 the issue had happened with China, many gaming apps, etc., they were banned. So automatically, if there is a ban on the app, then you need to look at the going concern issue automatically comes into effect. For example, if we can say TikTok. TikTok was one of the major digital content creation apps alongside Instagram. After the incident in 2020-2021, TikTok was banned from India. So automatically what would happen is it would create a going concern issue for the TikTok company which was there in India. We need to assess, is there any adverse impact on the company? You need to have continuous discussion with the management. See, it is not sufficient that as auditors, we have discussion with the management only when there is a board meeting. We should also have discussion with the management, ongoing discussion with the management and document it. We need to obtain legal opinion for those cases wherever we see that if there are any ongoing litigation, ongoing ban against the company, we need to obtain a legal opinion that whether the company is going to win the case. If the company does not win the case, is there a possibility that there could be an issue on going concern? So that will be decided based on the legal opinion. Note, there should be sufficient management representation obtained from the audit by the auditor. If required, as auditors, we should modify the opinion, provide an emphasis of matter or a going concern paragraph in the auditor's report, and give a note in the financial statements by the management. Certain other specific issues which could come as part of accounting or as part of auditing of these industries, there could be co-branding partners, banks, credit cards, etc. So, for example, I don't know how many of you all, if you go to PVR or somewhere, there are always people who are standing outside. They will be like, take this credit card, you will get 4 movies free in a month or something like that. So these are co-branded cards, co-branded with PVR plus whatever the credit card is there. So as auditors, we should verify how the sharing of revenue happens between the bank as well as the particular theater, PVR, what would be the treatment of discounts and treatment of offers? So, for example, today only I have booked a ticket from my card where I got buy one get one free. So if I got buy one get one free, who would be actually bearing that particular cost? The cost will be borne, cost of discount will be borne by the credit card or which is the bank, or the cost of the discount will be owned by the TV theater, which is broadcasting it, or the discount will be borne by the app where I'm booking my particular ticket, being book my show, Paytm, etc. How would be the treatment of promotion costs? Promotion costs are generally costs which are incurred before every movie is released, including the trailer, the other launches, etc. So we need to verify what is the treatment of promotion cost. Does it get expensed in the first year, or does it get amortized over a period of revenue collection? Similarly, reward points recognition, measurement, and accounting needs to be verified. If I'm using reward points on my credit cards to purchase some particular tickets, how does that get accounted for the different types of companies? Okay. Other specific issues, if we look at gaming industry, then what will be the treatment of development cost? We know as per AS 26 that any amount incurred in the research phase has to be expensed out, but any amount incurred in the development phase can be capitalized. So we need to verify what is the future economic benefits that is going to be received, compare the future economic benefit with the development cost. If the future economic benefit will be lower than development cost, check for impairment, etc. Obtain external confirmations as per SS 505. What is the organization structure? What are the, and if that generally what happens is in case of, let's say, for example, this companies, Balaji Telefilms, etc., these kind of companies, production houses, they would have many small vendors. So there would be a possibility that you would get very poor response from the particular vendors for external confirmation. In that case, we should have our alternate audit procedures ready by verifying either subsequent payments or subsequent invoices or past history, etc. So those things are something we need to keep in mind. After that, I would like to just coming to the last segment of the presentation. Certain case studies. Let us look at a few case studies. Let's say this particular case study, which was setting up of set-top boxes. Telecom entities frequently provide their customers with set-top boxes, modems, or routers as part of providing video or internet services. Many people would have Geo services at home. So there would be a router or a particular modem which would be there. Determine if the set-top box is a revenue element or a leasing element. So for the company, for Geo, what would be this particular set-top box? Set-top box would be a direct revenue that they will recognize, when they started with the free internet thing. They installed this particular modem or router. They took some 2,000, 5,000 rupees as deposit, and they installed it. And then based on that installation of the particular set-top box, we could use the Wi-Fi. Now, whether that would be a revenue for them or it would be the leasing element. So the telecom entity will need to determine whether set-top boxes are separate performance obligation or it is a part of the performance obligation, assuming that they do not meet the definition of the lease. Generally, of course, in this case, a leasing element does not come into picture because they are not charging us monthly for this specific thing. So it does not come in the criteria of lease. If the assets identified and used to deliver services to the customer are determined not to be distinct, the telecom entity will identify only one performance obligation for the monthly service and recognize the amount of transaction price allocated to this performance obligation monthly. Okay. Then moving to next case study, which is your subcontractor. So let's say, for example, a production company develops content and delivers its created content in tapes and discs to a broadcasting company. The content is a specific project, such as shoot completion of agreed episodes, shooting of completion of agreed episode, number of episodes. Now the parties responsible for the technical quality and delivery of the episodes, with the final episodes being approved and accepted by the broadcasting company. The company incurs all the production costs such as artist fees, shooting and location expenses, costume design, set hire charges, etc. So this is a very simple case. Let's say, for example, a company like Balaji Telefilms. Although Balaji Telefilms has their own production house, but let's say a company like Balaji Telefilm, they outsource production of particular sets of a particular show to some other entity. So that entity will incur all the cost. It will do all the recording. It will do all the compiling of everything and give the particular product to Balaji Telefilms again. How should the following be dealt with? The revenue recognized in respect of commission program, incomplete project cost, and recording of commercial and business rights. So how should this be dealt with in the subcontractor's books of accounts? So if we look at it, revenue recognition in respect of commission programs should be based on percentage completion method after considering different scenario for each project. Depending on each different project, it should be based on percentage of completion method. Any incomplete project's cost should be recognized as projects in progress for which no corresponding revenue is recognized. These projects in progress will be stated always at cost. You will not add any markup element. You will state it as cost because as of now, they have not been sold. And of course, they will be disclosed under other current assets. Recording of commercial and business rights, they are recorded at the original consideration payable at the acquisition date and amortized over their estimated useful life. So that is where it comes. Let's say another case study. In this case, a company has appointed a leading Bollywood star as its brand ambassador. We see a lot of advertisements with this digital media companies where they appoint a lot of Bollywood stars as their brand ambassadors. The key terms of the agreements are as follows. Agreement period is 3 years. During this period, the star shall make himself available 3 times for the purpose of promotional appearance. Each appearance shall not exceed 5 hours, excluding travel time. The star shall participate at the request of the company in one film, video, or photo shoot 3 times, each time not exceeding 4 hours, excluding travel time. In effect, the star shall spend 27 hours, excluding travel time. The star has to spend 27 hours, and the star shall be paid 270 lakhs at the beginning of the contract in full and final settlement of all his services. How should this particular transaction be accounted for? So if we look at this particular case study, in effect, the star has to spend 27 hours and the star will be paid 270 lakhs at the beginning of the contract. So the amount is being paid at the beginning. We need to understand whether this is a period cost. In the first year itself, you will need to, will you recognize the cost or will you amortize the cost over the period of service received? Let us see. The India's guidance requires services to be recognized as an expense when those services are received rather than when the entity uses them to deliver another service. So the services are to be recognized as an expense whenever those services are actually received. It also requires any amounts paid before those services are received to be presented as an advance. This could definitely be presented as an advance given to the particular star. He is under contract to give 27 hours to the particular agency. Consequently, the company will recognize expense of 10 lakh per hour as those services are, as and when those services are performed. So if we look at it, the star will be paid 270 lakhs for 27 hours, which means per hour the star is going to be paid 10 lakhs. Now, assuming 10 hours of services received in the first year, the company will expense out 100 lakhs and the remaining 170 lakh will be presented as an advance for future services. So this is how we will recognize the particular revenue, the particular expense in this case. Okay. Let's take up another one more case study of license fees. X Limited acquired broadcasting license that expires in 6 years. As per the observable past practice, the license is renewed by the government at marginal cost. So we see last observable whatever past practice is there, we know that license is renewable at 0 cost. There is no adverse condition that suggests that license will not be renewed. X Limited intends to renew the particular license. What will be the useful life? Will you consider useful life as 6 years or 12 years or 18 years or what? Because considering that the government has been renewing the license in the past also at no marginal cost. So in this case, the intangible assets useful life is treated as indefinite and the license would not be amortized. An intangible asset with a limited legal life is treated as indefinite if it can be renewed by the entity without substantial cost, and such renewal is expected. So here we will treat the license fee as indefinite, useful life. Okay. Let's take up one last case study on IPL rights. So let's say, for example, Moon TV acquires cricket broadcasting rights for the IPL season. Sorry, which will run for over a month. Now, Moon TV also acquires an old classic movie, which it can broadcast 10 times over the next 3 years. Now, this is not like your OTT platform, but this is more like your filmed entertainment, what you see on your TV channels. First, it acquired rights for IPL, which will run for a specific month. Then it also acquired one classical movie, which it can broadcast 10 times over a period of 3 years. Moonlit TV presents the broadcast rights as intangible assets rather than inventory. How are the two broadcast rights to be amortized? So let us see. When we look at IPL rights, after the initial recognition, broadcast rights are amortized based on the consumption of the future economic benefits embodied in the asset. In case of cricket broadcast rights, Moon TV will amortize the rights over 1 month IPL season, which is very simple. They have acquired the rights for one particular month, so they will amortize the rights over a month. If Moon TV continues to own the broadcast rights in the future, the amortization over the month will be determined after considering the residual value. Now, why will be determined? Now, why will the company still own broadcasting rights in the future? Because generally the rights will be given for 1 year. It's not only the rights of broadcasting the cricket live, but also showing highlights in the future. So those rights are also there. So here what we will do, we will have to determine something known as a residual value. Then after 1 month period, the residual value will be amortized equally over the useful life of the broadcasted rights. So first we will amortize over the 1 month period, and then whatever is the residual value, that residual value we will amortize over the remaining useful life. Generally, the broadcast rights will have significant value when the season is live, which is but obvious. Whenever the season is live, that will be the maximum value of the broadcast rights. The residual value will be comparatively very insignificant. Amortization method will be best suited in this case is a unit of production. Each broadcast over a 3-year term will result in 1/10 amortization charge. All right. Then this is okay. This is just another asset, another case study. Let us look at this particular case study. Co-branding partners have a tie-up with banks on which they offer discount and other offers on the credit cards, debit cards held by the customers on various purchases. How are such discounts and offers recorded? The portion of discounts and offers is borne by the co-branding partner and the bank based on the percentage agreed between them. So generally, there would always be a percentage agreement between the co-branding partner and the bank. And based on the percentage determined, they will be dividing the discounts and offers. Such offers and discounts are accounted as marketing promotional expenses between the co-branding partners as per the terms of the agreement. This was just one emphasis of matter paragraph which was given as part of the game's development cost, where it was mentioned that given the uncertainty around the useful life of the games, considering the dynamic nature of the business and fast changing environment, the company has decided to account for cost of development of games in the year in which costs are incurred. Generally, many times it may happen that the game may be uh, the game will be very much used or very much played upon only in the first year. So therefore, what they do generally, they recognize the entire cost in the first year itself once the game is released. No major cost of the game are in-house, like art, creative, programming, designing. The major cost of the games are in-house, like arts, creative, programming, designing, etc. Other direct costs are external costs incurred for production of the game, which are majorly outsourced, such as translation, etc. However, these costs are not a major cost of the games. All right. So this was just one of the para in one of the reports. With that, I finished my presentation. I would like to thank AASP and Anilji and Sanjeev Singhal and Mr. Vishal Doshi for this amazing opportunity for presenting on this lovely topic. Thanks. Yes, I'm done.
Thank you so much to both our speaker, Lakshay sir and Harshvardhan sir, for sharing their knowledge on this topic. I do have questions. Anil sir, do you have questions from our participant, if any? Sir, you are not audible.
Ma'am, you have questions now? You may
Yes,
please
sir.
start the questions from your side.
Okay, sure. I'll ask. I would like to ask Lakshay sir few questions. My
Yeah.
first question is, as most of the service providers of digital media are established outside India, will that be considered foreign company, and how to perform the audit and what controls to be implemented in the same?
Okay. Thanks, Rashmi, for that question. I think the second part of the question, where you said that how to perform the audit, that is a very extensive part. I'm not sure that I will be able to answer it in a complete detailed manner. But on the first part, yes, I think we need to consider the provisions of the Companies Act, where it states that if there is any branch of a company which operates outside India, so it falls into the ambit of foreign company. And on the audit side, we have almost covered like brief about the majority of the area, like Harshvardhan sir also covered on each and every area of the audit process. But I would like to cover on the control side of it. So to prevent the fraud, you mentioned the fraud, right? If I'm not wrong, to prevent the fraud. Okay. So to prevent the fraud, I think there are 4 or 5 major criteria we generally talk about. Is first one is the access controls, which comes with the segregation of duties as well, like on the on the data that the company is using. How, what is the access controls are, what kind of access controls are there, what kind of applications that they are using, and how they are segregated the duties among the access holders. So for example, if someone is preparing some spreadsheet or something like that, and the person who is approving it should be a higher authority above him, for an instance, or the
Sorry.
person who is creating a memo or a voucher for an expense, the person who is approving authority, there should be segregation of duties at each and every level of one second, level of approval hierarchy. Then comes, I think, the vendor management also is a major area where the controls should be there, from the creation till the payment. So these are the general controls that the companies in general environment also places to prevent the frauds. I think I
Okay.
was able to answer your question.
Yes, sir. Thank you so much for this answer. I have one more question.
Okay.
As in this industry, most of the subscriptions are done before the service performed.
Yeah.
So, are there any chances of deferred revenue in this industry, and what are the assertions for the same?
Okay, so like I covered in my presentation as well. So the deferred revenue is something where the company has received the payment in advance, but they are yet to perform their obligations or their performance obligations around it. So there is a chance, and there will always be a chance, because the companies are operating on a subscription-based model where you have to pay upfront, and then you will be providing the services. So in most of the cases, the companies generally operates on a deferred revenue model. And like we discussed earlier as well, the audit team needs to be very cognizant of the fact that there will always be deferred revenue, how the company is actually calculating or calculating the revenue, as well as what is the portion that is still there in the deferred revenue. So we need to be very cognizant of that, and to talk about the audit procedures around that. So we perform the other audit procedures on the revenue, all those 3 assertions that we talked about. So if we perform our audit procedures on those assertions, I think our majority of the risk will be covered.
Okay. Thank you so much, sir, for the answers. All the questions you have addressed it very wonderfully.
Thank you.
Now, I would like Rishu to go ahead with their questions.
Okay, thank you, Rashmi. I do have few questions. So one first question is, what unique challenges do auditors face when evaluating the financial transactions related to social media and influencer marketing campaigns?
Sorry to interrupt you, Rishu, but I think you were not audible clearly. You were not loud enough to understand the question.
Ishu
No
ma'am,
issue.
kindly repeat.
I'll repeat this, sir. So yeah, the question was, what unique challenges do auditors face when evaluating the financial transactions related to social media and influencer marketing campaigns?
Harshvardhan sir, you would like to answer or sir?
Yes, sorry. Hi, Rishu. Can you please repeat the question?
Sure, sir. So the question was, what unique challenges do auditors face when evaluating the financial transactions related to social media and influencer marketing campaigns?
So I'll tell you, relating to influencer media campaigns, as auditors, now when we say as statutory auditors, as auditors of who? As auditors of companies employing the social media influencers, or as auditors of the social media influencers. So I'll just take it up from both sides. First side, as auditors of companies who influence who hire the influencers. Majorly what would happen is we would need to obtain the agreement with the influencers, and after we obtain the agreement with the influencers, we need to verify what is their obligation in the particular agreement. So, for example, we used to do this particular tourism company and audit, and the tourism company had employed one of the cricketers to say that, when they were in that particular country, they were supposed to upload 2 or 3 posts. And for uploading those 2 or 3 posts, they were going to receive some particular remuneration. So the cost was, whatever total cost was there, was bifurcated over the 3 posts that the particular influencer had uploaded. So that is something that as auditors we can look at. One is the agreement and what is the obligation. From the influencer side, again, for them it is revenue. So I believe the revenue part of it, Ms. CA Lakshay can take it.
Yeah, thank you for your deliberation. I think on the revenue side as well, like we already discussed, there is basically the revenue will be recognized over the period of time, because there is a substantial clause in the agreement, like the example that Harshvardhan sir suggested. Like if they have to post the 3 post, and if if from the influencer's perspective, if they have the rights to receive it from the time when they have posted it on the very first post, they will recognize it at that point in time when they have posted it, because they are now eligible, they have the right to payment, and they have performed their obligations, they have performed their performance obligations as per India's 115, which we generally use for the revenue recognition.
Okay,
Ishu
thank
madam,
you.
next question.
Yes, sir. How do we decide the jurisdiction of taxation in multiple IPs used?
In case of multiple
IPs,
jurisdiction for expenses or jurisdiction for revenue, again,
jurisdiction of taxation.
jurisdiction of taxation. I think this would more be a tax question. I would let the tax experts handle it. I'm not from the tax side.
No
We will
issue.
forward the reward to the member. Yes, sir.
Okay,
Next
so
question, madam.
one more question. But how do we check with the evidences in case of different coupons used from different apps by the users?
That's a very good question. I think, how do you check what were the coupons used, etc. See, generally especially in banks, they would maintain a entire log or entire record of what coupons are used when. while giving the particular thing. And apart from the banks, also there are the payment gateways that we use. The payment gateways give a report of what offer was used and how much payment was received and how much discount was given. So from that payment gateway MIS report, from that report you can always track down whatever offer was used, etc. So payment gateway report would be one.
Okay. Thank you, sir, for your detailed responses to these questions. We appreciate the time and effort you have taken to address the queries from our participants. To conclude our session, I now invite Anil sir to share his perspectives. Over to you, sir.
Thank you so much, madam. Thank you so much, Harshvardhan sir. Thank you so much, Lakshay sir, for your expertise on this topic. You have covered all the aspects relating to this media sector. And on behalf of AASP of ICI, I would like to express my heartfelt gratitude as well as thanks towards both the learned speakers for sparing their valuable time as well as sharing their knowledge, expertise with all our members. As this sector is very specific sector and very different sector, and still both the learned speakers had covered all the auditing aspects relating to this sector. So once again, thank you so much both these speakers. And I also thanks both the moderators for today's webinar for wonderfully moderating this webinar. I also thanks all the participants for joining this webinar and patience hearing. Thank you so much. Thank you so much, everyone. Namaste.
Thank you, everyone. Thank you so much.
Thank
Thank
you.
you so much.
Thank you. Thank you. Thank you.